Hey everyone, and welcome to another episode of the Payments Strategy Show. I'm Joshua Silver, founder and CEO of Rainforest. We help software platforms embed payment processing into their core product to help them grow revenue and improve customer retention. I'm here today with our guest, Kevin Lee. Kevin has been a software and payments leader for more than 25 years. Kevin, welcome to the show.
Thanks, Joshua. Appreciate you having me.
Well, Kevin, let's start off with tell us a little bit about your background. I like to ask every guest, how did you even get into software and payments?
Started out in consulting at Accenture and wound up in their financial services group. So kind of made my way through financial services software, which ultimately became fintech, and then wanted to start my own company. And through the help of folks in the kind of fintech Atlanta, fintech area, Trip Rackley, Tim Tuff, others, got into that. And for the past 25 years, I've been running fintech and SaaS companies, everything from merchant acquiring to debit card processing, issuing, online banking, bill pay, those kinds of things. And the most recent thing I did was wanted to get into vertical SaaS. So worked with a company that embedded payments into a vertical ERP system.
Amazing. Well, you've really seen kind of all aspects of payments at this point. Curious, over the last 25 years, you've been in a variety of roles. In particular, the last few years, what have you noticed that has changed? What are some of the interesting trends that you see both in vertical software, but also payments, Kevin?
The biggest thing is just I kind of got out of payments and into vertical SaaS because standalone payments as a payment processor, you just do one thing and process payments, is kind of going away. Right? Everything has become embedded. It's all inside software, the UX, the economics, the data. When you think about a SaaS system and you're not thinking about payments inclusive to that, you really don't have a full solution. So that's been really interesting for me. And it's incredible to me how rapidly as well that happened. And then on top of that, Stripe that just ruled the world forever is now no longer the default solution. So as you know, with what Rainforest does and others, your options in embedded finance and embedded payments are awesome right now. Fantastic place to be if you want to be in vertical SaaS and embedded payments.
Lot to unpack there.
Yeah.
Let's start with first the trend of moving towards embedded payments. First of all, couldn't agree more with you. Obviously, the whole premise of Rainforest is software companies embedding payments. So huge believer in that. The analysts all, every which way you slice the data shows the fastest growing segment of payments by far is embedded payments. What do you think are some of the best predictors of success for vertical SaaS companies that are getting into the payment space?
Yeah, in general, you're always looking at, when you look at a company, you're always looking at growth rates and margin expansion and predictability, those three big ones, but specifically around SaaS and payments, average revenue per account or average revenue per user, it depends on if you're a B2C company or a B2B company. That's the thing that I always look at. At my most recent company, we had a situation where just selling software, we were not monetizing payments at all. And now that we've begun to monetize payments, in essence, average revenue per account will double with no, additional direct cost to our customer. So it's fundamental, again, not just to the business, but the economics and the value of the business. In essence, will it be at least 2x, if not more, because that payment stream is obviously incredibly recurring, but it's also got an amount of intelligence that goes along with it. So I think about, in the vertical ERP system that we ran, we're constantly looking at how many proposals are our customers creating in the system, because that's ultimately going to generate revenue for them. But we could come back and not only show them how many proposals are actually turning into accepted projects, which they knew very easily, but we could also tell them the type of proposal that they were presenting, how quickly were they going to get paid on that relative to other projects. So, hey, are you looking for something that's a project that's going to take you 2 years and you want to get paid on a quarterly basis, or do you need some quick turn for cash purposes because they're basically services businesses? That intelligence that went along that just made our relationship even stickier. So it's pretty significant what payments can do. The other piece, I think, is it informs your ICP. In the early days, the difference between someone using your software and using the embedded payments and financial pieces that go along with it really narrows the ICP, because you're hitting a pain that in often situations they didn't know they had that pain. They were going in to use your software to be an ERP system. They weren't expecting to find the opportunity to do short-term credit or to do, instant payments, or even to accept a $20,000 ACH and get paid in 2 or 3 days. Those things weren't even available to them. But then when you see them using them and then continuing to use them, you've clearly hit on something that's going to point you to your most valuable customer. So you're using, payments not only to monetize, but to point you to your ICP. But, that becomes the value that creates the stickiness. It's no longer one product. They now look at you as doing multiple things for them, which,
Right.
In SaaS, that's what you want. You want them starting with one piece in that wedge and then continuing on to the high retention.
Yeah, I hear pretty consistently from clients, from guests on the show, from investors, when you add payments into the product, churn goes down precipitously, because when you can go from a world where you're just providing software every day to a world where you're providing software but also putting money into their bank account.
That's right.
You are the lifeblood of the revenue for that business. It's a total game changer. And, I'm glad to hear in your last company that, like so many others, you're able to start looking at doubling the business by adding payments. And, I think you brought up a good point, which is it's not even that the customers are spending more incrementally. It's really a share of wallet question, right? They were paying some other payment processor for these transactions anyway. If you can, for the same or roughly the same cost, process those transactions, but doing it a consolidated way, you get the dollars, you get the data all together. Customer has a better experience. You have a valuable revenue stream. Really, the only loser in this whole situation is the legacy standalone payment processors, which is why those businesses are ultimately seeing very slow growth, if not negative growth.
That's right. Yeah, and when you reach out and try to get them to move from their legacy payment provider and they don't, that is also an indicator of what's going to happen to that business. In customer success, you want your success to be your customer success. And then if somebody's already got a legacy view of their business. We had someone just a few weeks ago tell us they didn't want to change their processor because it was linked to their local bank. And they were going to retire in the next couple of years, so they didn't really want to rock the boat. And, note to that customer service manager, they're like, okay, I'll come back in about a year and let's see who your successor is, and we'll figure it out from there, because you're not really going to take your business forward if you're not willing to do something like this.
Kevin, let's go a little deeper on payments. For a vertical software company that doesn't have embedded payments yet, they haven't embedded any fintech yet, is there anything they need to have in place before they add payments? Are there any kind of foundational elements? Are there any conditions or prerequisites that you think, in your experience, will help them be very successful with ultimately getting payment adoption and driving revenue and driving margin?
Yeah, you get a lot more of these calls than I do, but I get a reasonable number of them of either investors in vertical SaaS or CEOs of vertical SaaS companies that say, hey, I'm going to monetize payments.
Yep.
What should I expect? And they're wanting to know how much more money, what's revenue going to increase, right? What's net retention going to increase? And there was one group that I was working with that was they kind of service the independent automotive business. And what they came back and said was, we added all these great things, but, adoption's been very little. And when you talk to them some more, what you realize was the use case that they had was only going to capture maybe 20% of the customer base basis payments. So they had a text-based solution for independent automotive repair, right? So which is very popular these days. And you think of someone that, I want to pay for my daughter who is got a car off in college, send me a text. I can pay that way, or I'm picking up after hours. But what they learned was 80% of the people, they're being dropped off. So they're walking into the office and they're pulling out their credit card and saying, tell me about my car. Did it cost as much as I thought? All those kinds of things. So to get back to your question, I would understand the use case that you want to go after and understand the use case that your customers are expecting. Because what we found in that scenario was, you would think a small business would want to consolidate as many things as possible. They were okay having two separate solutions. Hey, I've got an after-hours solution and I've got an on-prem solution. So they were thinking that if they offered payments, they're going to be able to capture 100% of the wallet. And I would just say, number one, understand the use case. So understand your customers, understand that process, and really ask and figure out what they want to do. So you align that adoption risk along with, what your payments are actually capable of doing, as opposed to saying, if I roll it out there, I'll definitely win. That's probably the biggest thing I see people make a mistake.
Interesting. If we talk a bit more about focus. So you've decided, fast forward, we've decided there is the opportunity to add payments. The use cases are right. We maybe have a right to win, but maybe the software company isn't focused on payments. It's an afterthought. It's just an extra module. What would you tell them, and what would you tell that leadership team and board if you were advising them? You've got an underperforming payments business today. What would you tell them?
I mean, they're leaving money on the table across the board. Someone is capturing that value. And as you know, if you can embed it into your software solution, it's not just, I'm going to change from a banking provider to a software provider and it seems more technologically advanced. You're adding value because all of that data stays in a single place, right? Yep. So that's the biggest thing that I would tell them. The next is, again, I think there is this assumption that because it has been so successful in so many businesses that I can just add it to my SaaS platform and it's going to take off like wildfire. And I again sat in with some calls with another company that I was working with, and the customer service manager just wants to call up and talk. And first call we have, person goes, well, what are your rates? And they tell them the rates. They go, well, I can't do that because I pay 1% for credit card transactions today. And I wanted to laugh out loud. But we get off the call and I turn to the customer service manager. I go, what do you think we could have done differently? And they go, well, we can't beat 1%. I'm like, no one can beat 1%. Right. There's no such thing as a 1% credit card process. Yep. So the moral of the story is understand what objections you're going to run into. And one of those objections you're going to run into is payments it is a very deep, almost black box industry that a lot of people hear a number and they go, well, that's what I pay. I pay 1%. Yeah. So be prepared for those objections to educate people along the way. The other is a lot of times they'll go, oh, that price is great. I'm not the decision maker, but before I take this to my boss, what's going to have to change in the process? Right. So you got to be prepared to say, well, tell me about your process today and I'll tell you how it's going to work. And then the other is you're just always going to run into some BS objection, for lack of a better thing, that somebody throws out there, like this independent automotive repair. I went on some ride-alongs with them. The guy's like, well, I can't do it because you guys don't accept fleet card. And the CSM, same thing. They put their head down and like, well, let's get out of here. I'm like, wait a minute. Yeah. Do you even know what a fleet card is?
Yeah. Is that even?
Ask the question what a fleet card is. I'm like, I'm pretty sure that's a Visa card. Do you have one here? Yeah, here's the card we accept. Visa logo. I'm like, it's a Visa card. You're fine. Do you accept Visa? Yes. Okay. Continue the conversation. So there's a lot of customer service manager, sales management, just being trained and prepared for the objections. And if you don't have those, what I found works really, really well is just a single person that knows the payments, cold. If they've come from the payments industry or they've been, educated by whoever they're partnering with on payments, you can get that objection usually stomped out, like the 1% one pretty quickly so that you can find out if they really want to buy or are they just throwing that up as an objection because it worked on all the other payment processors that tried to sell the payment processing.
Yeah, it's still amazing in this day and age, how much obscurity there is around the rates and how hard it is to tell. In my last company, Patient Co that I co-founded was in the healthcare space. So we sold to really large health systems. These were sophisticated, multi-facility groups, in some cases, hundreds of millions of dollars of payments. And very frequently they would tell me, oh, we have the best rate we negotiated, 1%, 1.5%. And I'm like, yeah, but that's probably not all in. Maybe one interchange rate on one transaction was 1.5%. Inevitably, we would do the rate comparisons. We get all the bills from all the different locations. I'm all up in Excel and present it back. And the ones who thought they had the greatest rates actually in general had the worst rates. And we found some health systems paying over 4-5% for card payments where, that probably should have been in the low 2s for their volume levels. So,
and as you know, the legacy industry has made an incredible science out of making that as confusing as possible on a monthly basis to take your statement and go, how much did I pay? Whereas in the embedded world, transparency, and Rainforest is exceptional at this, of just the transparency and simplicity of how much did my customer pay me? How much do we have to pay somebody behind the scenes, and then what's ultimately going to be our take on that? That's a single report that anyone could read left or right and answer very quickly. So educating yourself is going to be a lot easier when you're going with something that's technology based as opposed to kind of legacy based.
Got it. So we've got the right to win. We looked at the use cases. We're good. We've got the subject matter expertise of the SMEs in place to answer these questions. The next up is really choosing a payments provider. Most software companies, unless you're doing many billions of dollars a year, when in that case maybe you bring it in-house, you're going to partner with someone. These are just in this day and age, you don't build it yourself anymore. It doesn't make sense. It's too high of a cost to build it yourself. So you're going to partner. What do you think software companies should look at when choosing a payments provider? Kevin, you mentioned earlier Stripe is no longer the default. Would love to unpack that a little bit. Why is Stripe no longer the default, and really what should people be looking for?
Yeah, I may have some bad people from Stripe sending me emails after this one. It's the first step. I would take a look at who you're doing processing with today, and you'll be probably shocked and not pleasantly surprised by the things that aren't yours that are actually theirs. And this to me is I think Stripe has probably gotten better at this. The legacy providers certainly use this as a way to anchor the relationship and, companies hostage. So a reason that it needs to be, in the SaaS world, you need to look at payments as part of your business model from day one, as opposed to kind of to your point, I got to, a couple of $1 billion in volume. I want to increase my my monetization of this, let me change providers. You've got years worth of payment data and customer data that's in there that chances are great doesn't belong to you, doesn't belong to your customer. Right. It belongs to that third-party processor. And they're going to use it as a way to hold over you, either economically or from a transition perspective, to make it really painful that business case your investor put together that said, you can go from 5 basis points to 35 basis points, that now is 2.5 years away before you can realize that, just simply because of the relationship you've got with your payment provider. So number one, I unfortunately pull out that contract, take a look, hand it to an attorney, run it through ChatGPT, whatever you got to do, and buckle in for what you're going to see. So another tough story, bad story. I started running a vertical SaaS several years ago, and they had a Stripe Connect relationship, which everyone knows is a referral where you share and have a joint relationship. And part of the reason that was brought in is because there was some churn going on in the business. And so I was following up with customers and saying, hey, can you help me understand why you left? And we heard all of the typical things that were our problem, our technology, those kinds of things. And one person at the end of the conversation said, but the thing that really made me feel comfortable about leaving you and going to the competition was I could take my Stripe account with me. I'm like, excuse me? They said, yeah, Stripe had a relationship with you, and Stripe has a relationship with your largest competitor. And so I called up Stripe and I said, what do I do? And they said, not a problem. We'll just port your information right on over, because it was Stripe's. So I called up my account manager at Stripe and I said, I thought we were partners here, right? That's fine. Let the customer do what they want to do, but you advocated for them to leave me, and I'm the one that paid to acquire that customer for you, right? So I can get pretty fired up about that one. So I would just be, in the early days, again, look at your business model. The easiest way in a lot of times is, let's do this, joint customer thing. Let's share it. That's fine if that's an easy way to get the business going. And from a technology perspective, I would just be, buyer beware that relationship. And when you're partnering with you're starting a vertical SaaS company, you're probably sub $1 million in revenue, going up against Stripe that's, multi-billion dollars in revenue. Guess who's got more resources to go out there and grab that relationship away? They're gonna take it from you and not think twice about it, which is very, very challenging for someone that comes from the payment space, because we were always there to help our customers as opposed to kind of take the customers away. So it's a jaded point of view. Sorry about that, Joshua.
Yeah, well, I think you bring up a good point, though, that someone like Stripe that's powering many platforms, and it isn't a white labeled solution, you have that shared ownership. And in fact, even worse, we see some companies now that serve both vertical SaaS companies and direct merchants. And so now you've got your payments provider who's, kind of giving you the wholesale rates, if you will, that's now trying to undercut you by going to one of your big merchants directly. And I've seen that a lot. That was one of the kind of fundamental decisions we had to make at Rainforest early on, was what's the space we're going to play in? And we decided we're going to align ourselves 100% with the vertical SaaS companies. We're not going to compete with them by serving merchants directly. We're not going to, have a shared relationship. It's completely white labeled. And so even if we were working with two competitors and, a merchant moved in between them, we would be completely out of that. I think it takes a lot of discipline to do that, because there are often opportunities where we could go direct, but it creates such channel conflict. We've seen that play out time and time and time again for 20 years. So It's a tough situation.
It is. And when you can white label that solution, right, and brand it as yours, as we did at my most recent company with y'all, it doesn't even bring that opportunity up to the customer. The customer would never think to get in touch with Rainforest. And granted, even if they did, you guys wouldn't do that to us. But it's your product, right? So it's just an extension of your solution, which again, I'd hit on check your contract, those kinds of things. Make sure it integrates with your business model. But then the final piece is just the flexibility of integration. What do you want to do? What do you have the options to do? I would definitely look at optionality between just, I want to accept credit cards. I mean, that's where everybody starts.
Right.
But as you know, the number of times that someone said, well, I want to accept credit cards, but now I'm getting into a higher end market or maybe some larger implementation fees and no one wants to pay the $20,000 on a credit card. How do I add ACH? I'm like, does your payment processor support it? Because if they don't, you've now got multiple payment processors.
Yeah, it's going to be a disjointed experience. It's a mess.
It's really, really painful. So I'd look into that. And then finally, good reporting. The reporting portal at Rainforest is a good example of something that's just, it's straightforward. There were very few people in the organization that used it that had questions about what does this mean, right? These are dollars coming in, these are dollars going out. Here's the Rainforest fees, here's the Visa, MasterCard. It was very straightforward. So that's the final piece, because then you can turn it over to other people to help you start to understand the economics of your business.
Yeah, makes total sense. Well, Kevin, you've led multiple companies to successful exits. I want to talk about that for a little bit. How do you find that having embedded payments impacts valuations? And that could be, I guess, for raising money late stage or for an exit.
Yeah. I mean, it's a net revenue retention. That is kind of the gold standard in the SaaS investment world. That if I could ask somebody, if they go, my business is crushing it, one question I would say is net revenue retention. It tells me how many customers you're hanging on to, and those customers that you're hanging on to, are you doing more business with them? And the difference between those with and without payments is material, right? So you're typically looking at a SaaS business that's going to have net revenue retention in the, high 80s, low 90s, as opposed to one with payments is going to be 110, 115, hopefully up to 135%. Of a couple of companies ago that I ran, we were, 135%, and it was based on payment acceptance and payment growth, right? So our core product was continuing to win against the competition, but for every win, we were making more money. And it was, that was the piece was the difference in payments. And so, yeah, you can, when you go to sell that company or value the company so that you can do different things and you've got optionality from a capital perspective, that is the gold standard, right? If you can demonstrate high net revenue retention, payments is going to give you that extra boost, and it's currency, right? That you can use to increase your access to multiple ways to finance growth.
Any decisions you can think of that SaaS leaders should make, besides doing payments, obviously, to really maximize their future value? What are those hard-learned lessons there?
The biggest thing that I've seen recently, there are a couple. I'm going to unfortunately use AI as one of the examples, but the biggest thing that I've seen is just fewer systems. If you can walk into a situation and say, I understand my customer well enough. A lot of people sell quote unquote integrated systems. And when you get under the pain of that, underneath that pain of that is, well, you're telling me I can use your system as opposed to these three different systems. And it may not be perfect, but I understand your pain well enough. Fewer systems done in a very unsexy way always wins, has been my experience. And again, once you can add on that second and third thing that you do, you're adding payments to that, you've now created something that is like an ecosystem. So that's the one thing I always look for is kind of you helping that business simplify the number of software solutions they have, and are you solving the unsexy problems for them? Because if so, you're going to do a lot of business with them, which is great. And then the reason I think that's going to become more and more of a problem is AI is just allowing us to build software faster, really decent software. I won't say great software, but decent software that solves a very short-term problem quickly. And at my last company, we were adding, it's embarrassing, probably 7 or 8 SaaS systems a year to marketing.
Just to manage things. Just to manage things.
Right? Whatever it may be. But the partners that we worked with the most were the ones that came in and said, hey, we get it. We understand it. We solve this problem for you all the time. Our XYZ system may not be as great. Our chatbot may not be as great. Or Our orchestration may not be as great, but it's all going to go to one place, and it's a system you already have. And so you can eliminate those other things. And most of the time you're eliminating those other things, you're reducing cost in the process. So those are biggies. So again, not a Rainforest commercial, I know, but it was one of the things that we enjoyed as we continued the relationship with Rainforest, is that we could continue to use more things to advance the payment solution by just further using your platform. And then you've got partners on top of that integrate so easily that we could expand out. And to us, it was just like using an extension of Rainforest. We were just using Rainforest. So again, a very unsexy problem, but it was solved elegantly and well. And I think that's the kind of thing that just creates a lot of value with customers.
I'll pivot now to leadership in general. You've been the CEO of multiple private equity-backed companies. It's a particularly unique role because you're not the founder. You're coming into an established business. Generally, if private equity has come in, they're expecting big returns or expecting big changes. A lot of pressure there. What do you do as CEO to create conditions for success amongst your team?
That's a good one. One thing is just clarity of why are we here? Why are we doing what we're doing? Most of the time, you're right. I'm not the founder. My next creative idea will probably be my first creative idea, but I do know how to grow businesses. And so it's somebody else's investment thesis that I'm now taking and trying to turn into a reality. So number one is let's get real clear on that investment thesis and why are we doing what we're doing? Because a lot of times, that's not clear, or it's clear to 75% of the people and maybe 25% aren't being held accountable to continue to do that. That's one. The other is hire great folks, great people, go a long way, because they'll give you the feedback. If it's not working, if they can't make it work, they're really good at what they do. They'll come back and go, you're asking me to do something that just isn't doable. Or you can spend time with them and they very quickly pick those things up. And then hold them accountable. Everyone hates the weekly meeting or the daily stand-up or all those kinds of things. But the reality is, as human beings, we respond to what somebody else expects from us. And so if you expect me to show up at 9:00 every morning and tell you what happened yesterday in this urgent thing, I'm going to make sure before I finish today, I've got something different to say than I did the day before. And the same goes with weekly meetings and quarterly board meetings. So yeah, that's probably the biggest piece.
It's what gets measured gets managed.
That's right. That's exactly right.
Well, Kevin, as we wrap up here, if you had to distill all your experience, 25 years plus, just into one last piece of advice for SaaS leaders about driving revenue, retention, enterprise value with payments, what would it be? Closing thought.
Yeah, that's another 25 years in one statement. I'll throw AI in here as well, and this is the counterintuitive or unpopular. In vertical SaaS with embedded payments, own the workflow. These simple workflows, yes, AI is going to play a fantastic role in, but we've seen even in complex law firms, complex workflows, people have to be involved, which means your software can be involved, that you've created a barrier. So number one, I would say own the workflow. The second one is embed the payments. Embed the payments, and again, my last company in the procurement piece, we were involved in the wholesale, the retail sale, and then we could do short-term financing on both. So for what was historically one transaction, we could touch it and monetize it 4 times.
Amazing.
So you can take a very straightforward, again, unsexy business like procurement and turn it into something that's, 2 or 3 times its value just by adding embedded payments.
That's all we got time for, Kevin. Thanks so much for being on the show. Really appreciate you sharing some of your experience and wisdom.
Great. Thanks, Joshua. Appreciate you having me.